My name is TF Chang. So I'm the CEO of HashKey Pro, the digital asset trading platform under the HashKey group of companies. So the panel that we have here is what I call a reality check panel, right? And I'll just read off from the title, right, on the agenda. Right, the topic we'll be exploring is asset allocation. Where do digital assets fit? Right, and perspectives from mainstream traditional investors. And we will explore together, firstly, the framework that traditional, institutional, and mainstream investors use to make asset allocation decisions and to decide whether an asset class or a new asset class is investable. Right? And in that context, we will evaluate together digital assets, right? Whether digital assets today can be considered an investable asset class from the mainstream investors' perspectives. So we have assembled today a panel that comprises of very seasoned veterans from the mainstream investment world. I will not be introducing each speaker in detail. Their bios are all on the web page. You just hover over the pictures and it'll be there. But they would represent separately investors from the pension world, the insurance world, the asset management world, and the VC world. So we'll have a very nice spectrum of views. To kick it off, okay, I shared with my panelists a report from Cambridge Associates, which is a well-known traditional investment consultant. Right? They published just last month a report called Crypto Assets, Venturing into the Unknown. In the 10-page report, Cambridge Associates basically made the argument that digital assets should be considered seriously by institutional investors as an investable asset class, right? Even though it's still very early stage. So with that as a backdrop, let me jump straight to David Ellington, who used to serve as the trustee and commissioner of the San Francisco Retirement Board, which is a major pension fund. So David, you know a lot about pension funds. Could you share with us, from the perspective of a pension fund, how would you make asset allocation decisions?
Thank you very much. I'm honored to be here. Basically, you touched on one thing, and I have to disclose Cambridge Associates, so it's very clear to everyone's mind. A pension fund, San Francisco Retirement Board, we were about a $20 billion fund. I was chairman of the board, chairman of the investment committee. So I was actively involved with all of our investments. We had, I was, let's say, for example, an LP or limited partner with over 20 funds around the world. So I got to know private equity, venture capital, real estate, a whole bunch of different things pretty well. The way a pension fund works is there's that board at the top, and then there's the staff, the chief investment officer, and they're the person who focuses on real estate, the person who focuses on equities. And then the third part is the consultant. And what TF just mentioned was Cambridge Associates. So I'm intimately aware of Cambridge because I actually led the charge to fire them from the San Francisco Pension Fund when I was there, because they were so conservative. The role of a consultant really, in my mind, has kind of evolved into just saying no. So they're that part, so when the board wants to do something interesting or the actual staff wants to do something interesting, a new asset class, it's the consultant, no, you shouldn't do that, and they usually even try to lobby and get the people who are beneficiaries of the fund, like the cops, the firemen, those beneficiaries of that pension fund, they talk to their unions and they say, you know, you guys shouldn't allow them to do that. I was very, very surprised and pleased when Cambridge put out a report 30 days ago that said that now digital assets should be reviewed and should be considered as a part of a portfolio. Now, of course, they didn't pioneer it. 3 to 6 months ago, David Swensen of Yale University's endowment was the first major, most famous person in the whole institutional investment world to say, oh no, at least 1 to 3% of all of your assets should be actually digital. So I'm very pleased. So to answer your question, the way it works and how we decide on asset allocation is that triumvirate, those three players agree, or you can get sometimes a strong board that says, no, I want to do this, I want an allocation at a $20 billion, give me 1%, that's, at least, $200 million, and that's what I want to allocate. That can happen, and it recently happened in the state of Virginia, also in the last 30 days. This is all new for institutions. This made an allocation to Morgan Creek for their new digital asset fund, a direct fund. It's a crypto asset fund that's specifically investing in venture capital firms that are going to do, a venture firm that wants to invest in a wallet versus a crypto fund that wants to trade. They have the flexibility to do both. So it's just happening in the last 30 days.
Okay, we'll come back on that topic a little bit more detail, but let me go down the panelists also as a way of introduction for the audience. Don, sitting next to David, is the CIO of Asia Capital Reinsurance Group, and he's actually a multi-award winning CIO for many years in this region. So he certainly knows how insurance companies as a whole executes on asset allocation and how do they think about asset allocation. So Don, could you share with the audience from an insurance perspective, what is the paradigm that you currently use today to make asset allocation decisions?
Thanks, TF. As you can see, that I'm probably the most conservative guys in the whole panel, and I'm still waiting tired at the moment. I think I have been managing insurance investment for almost my whole career. As you know, reinsurance is highly regulated entity. So all of investments are regulated by the regulators in terms of capital charge. So you have, in Europe, you have Solvency II. In Singapore, you have RBC II come out. In Hong Kong, the same thing going to happen as well is RBC II. So it's risk-based capital. So our role as a CIO is make sure that all investment meet the regulatory requirements and also the rating agency requirement as well, because we are all rated single A and above. So by doing that, we have to make sure we consider all the assets class through the risk-return profile, the volatility, the correlation with each other, make sure we will meet our liability requirement for our policyholder. At the same time, maximize return for our equity holders, means our shareholders. So this is how we operate as asset allocation framework. So basically, it's most important is make sure you are meeting the regulatory and rating agency requirements so you can survive in any situation. Second is, of course, maximize the return and meet the liability requirements. When we consider all the asset class, we look at it we usually look into very traditional, as TF put it, traditional asset class, stock, bonds. But we also look into the alternatives. But all alternatives so far haven't included digital currency as an asset class so far, but I will explain in details why we didn't include it at the moment.
Thanks, Don. So for the first round, we're just setting the rules of the game, okay, the existing rules, and then we'll bring in digital assets to see if they fit or not. Okay, a little bit about myself. So prior to joining HashKey Group earlier this year, I was with the asset management industry for about 20 years. So in that span of 20 years, I've gotten to know Jonathan, who has many years of experience advising and consulting asset managers, right, institutional investors. So Jonathan, could you share with the audience your perspectives from an asset management point of view?
Sure, I'd be happy to, TF, and thank you again for having me. It's an honor to be here. And good morning. So my prior background is having spent 10 years at a small consulting firm advising on these traditional asset managers. And asset management is a very broad term. And to be more specific, in this case, it's the long-only public mutual funds. So the really big asset managers, the likes of BlackRock, Fidelity, Vanguard, State Street, Franklin Templeton, these BNP Paribas investment partners, these are our clients, and we help them in developing the right go-to-market strategy, especially when it comes to China. And so we know quite intimately what really drives their decision-making process from a corporate strategy perspective. And when I say that, it's product strategy, it's distribution strategy, it's how do you get the right clientele to get excited and interested in your product. And of course, it is the investment strategy as well, but we leave that to other groups. And luckily, we weren't fired by anybody as a result of doing so. We tended to focus more on the corporate and marketing side. And so what I've learned over the past 10 years of doing that sort of advisory to these long-only mutual funds is that they're very focused on giving people what they want. And everyone, as can be expected, is very fee-focused. And what with the trend of moving from active towards passive, I think most of the massive, very large-scale asset managers have followed suit, if not, have led the charge themselves. They've followed suit in trying to develop these strategies that cater to the specific demands from the market, from retail, and also from institutional investors as well. And that's to go towards a strategy that is very low fee, very efficient, makes for good access to beta, so to speak, so market exposure, and not necessarily focused on active, so-called trying to generate alpha is no longer in vogue. So much of the demand that we see nowadays and the shift towards allocations is to gain more beta exposure and to do so through ETFs. And that's why you have the likes of State Street and Vanguard and BlackRock having accumulated so many more assets over the span of the last 10 years. And that trend seems to continue. Now, if you look at that's sort of the broader context of the general asset management and then more specifically mutual fund industry. If you compare that in size to the size of the current digital asset industry, it's quite stark in comparison. So I just looked up recently, in the traditional asset world, you have 75 trillion US dollars of assets under management. And you compare that to, just this morning I checked CoinMarketCap of 141 billion, that's really a drop in the bucket. It amounts to less than 0.2%. And so you can look at this in two ways. One is that, okay, wow, that's a huge opportunity for growth. We're just scratching the surface here, guys. And we see a lot of narrative out there in the public domain that follows that sort of theme. But you can look at it another way as well. There's a reason also why there hasn't been so much take-up from institutional investors in the traditional asset management space into digital assets, and it's because it's not yet ready. There's a lot of things that we need to do to get us from point A to point B, where institutional investors are actually going to be investing more heavily into digital assets.
That's a great summary, Jonathan, of where we stand. Indeed, I think for HashKey Group as a whole, and probably most of us in the audience, we are expecting that those trillions of assets sitting in the mainstream world will start to move into the digital space. The question is, what hurdles need to be overcome? What are the real issues out there that needs to be solved before the mainstream investors can take the digital assets seriously as an investable asset class, which today, really just scratching the surface. Okay, I'm going to just jump now to Jason, who comes from the VC world and the tech world, both in Silicon Valley and Asia. He's got many years of experience. So, Jason, you're running a VC fund now. Could you share from the perspectives of a VC?
Sure. Thank you, TF, for inviting us. I'm on the other extreme. I don't wear ties. I'm wearing jeans. I'm the only one here. So I guess VC on that space is we represent the more riskier kind of investment. We look into startups. Our fund traditionally looks at tech investment in Southeast Asia. Maybe to put this in perspective, in 2018, I believe I was just looking at the statistics, there were about over $3.9 billion worth of investment from the VC into digital, blockchain, crypto kind of companies. So it's significant, but yet in the entire space, that's still a very small amount in terms of the kind of VC investment. That being said, lots of big VCs are starting to invest into blockchain. Andreessen Horowitz, a very big, famous VC in US, they look at blockchain as one of their key components. So from asset allocation point of view, I think from the VC standpoint, we are looking at startups. And for startups, the span could take about 6 to 7 years to exit. Now, that being said, we also have to look at what the LPs want. So what are the investors of the fund are looking at? So from an asset allocation-wise, we don't really look at digital assets unless we raise a secondary fund. Then we start looking at that. Because once you start a fund, we have to stick with the mandate that we actually set forth for the investor. So from our point of view, asset management will come later. So there are some funds who are willing to take the risk. They don't want to miss out. So they will look at certain allocation of their fund on digital assets. So that's how we look at it.
Thanks a lot, Jason. Okay, with time running down on us, let me jump straight to the jugular, maybe, right? So digital assets, right? From the perspective of each of your investor category, right? Are we ready? Are you ready for digital asset to be allocated in your portfolio? If yes, if no, why?
Okay, so again, I'm the former chair, so I did it for about 5 years. So what is and I'm still heavily involved with that world, and I wear two hats here today. So one is my experience as an institutional investor, and I'm gonna respond, and then the second is the founder of Silicon Valley Blockchain Society. My reaction is that no, I do not see necessarily, I think it was an anomaly, and it's a crack in the wall, is what Morgan Creek just got done by getting the Virginia Fire and Police and another Virginia fund to fund them, write a check to the tune of, and they're the only LPs, and basically it's a partnership. And they also had a long relationship with these two institutions, these two funds, to be able to fund them, $40 million. But on Silicon Valley Blockchain Society, I can see us eventually issuing, yes, an SVBS, Silicon Valley Blockchain Society token, but I don't expect any of the institutions to buy that or to use that digital asset. What I see is what we're also planning to do is do a wrapper around all the investments we have and offer a security certificate, a traditional instrument that institutions can use. So, and be able to acquire and trade. So they don't even need to go to their board for permission to do a stock certificate. And that's what this digital entity, the Silicon Valley Blockchain Society, is intending to do, to be able to come up with an instrument, a product to sell to institutions that fit in their normal bailiwick.
Very exciting. So if David comes up with an instrument like that, Don, will insurance companies start to allocate?
I think you have to differentiate between the cryptocurrency with blockchain technology. On the blockchain technology, as you know, reinsurance company is really exploit. It's already using it to a certain extent. I think it's on the reinsurance world. We're starting to using blockchain technology to place our insurance contract with different reinsurance company. So this blockchain, the technology, we are actually will be heavily used going forward. That's for sure. So the related venture capital, as David said, we will invest in, because as we actually have some minor investment into one of these blockchain reinsurance platform already. So this one we will invest in. But cryptocurrency itself is the difficult part, because for one thing, it's very difficult to differentiate the risk return from Sharpe ratio point of view. I think we used to be very good before 2018, as from return from volatility point of view. But last year, has proved to be, it's very bad. And also the correlation with other asset class, actually we used to say this is not correlated, but last year, everything going down together, except the gold is actually doing well. So basically from that point of view, you have difficult to justify from cryptocurrency point of view, what's the position as asset class can sit in your portfolio as a whole. That's a big issue we are facing. So especially now we are as an institutional investor, we are going beyond asset class to so-called factor investing. This is new dimension we are looking into at the moment. So we basically analyze each asset class by factor. So you have equity, you have fixed income, then what's the factor behind of in terms of return, in terms of risk. So how we analyze cryptocurrency in terms of factor, I guess you will be very, very tough. I mean, this is going to be very, very big challenges. We need a lot of data and a lot of trading history to justify it, and also the economic value behind of it.
Thanks, Don, for laying out all the challenges, which is a very good reason why all of you should stay for all the sessions after this, because we have sessions that basically try to address each of those topics, from valuation to accounting to custody to AML, et cetera, et cetera. Right? So we need all those solved before we can really look at this as a mainstream investment. John, you already mentioned that there are some challenges that need to be overcome. Elaborate.
Absolutely, and I can just follow on from some of Don's points just now, and also just to set a little bit more context. In addition to the 10 years I spent advising on traditional long-only mutual funds, I also did an ICO for my research company, Red Pulse, and have later, just in the past year, have been a co-founder of Ledger Capital. So I've come across the entire spectrum of being from the very traditional side to now being supposedly very aggressive and being fully head-on dived into the digital asset space through Red Pulse and also Ledger Capital. And to answer your question as to what else needs to be done in order for us to capture more interest as well as capital from traditional sources, I think two things as well. First, the demand has to be there. And while there has been so much buzz surrounding Bitcoin and tokens, digital assets, you still don't see the majority of the global population engaging in this sort of investment or even interest in this sort of investment. So that's one major thing. The second thing, of course, is the infrastructure involved in executing all of these transactions, these investments. So right now, there is no standard in place for custody, for settlement and clearing. Not to say that there can't be or won't be, certainly there will. And people, and I would actually argue in favor of the fact that, of the idea that blockchain would actually make it much more easy to actually produce these custodial as well as settlement and clearing services, even the definitions of which may not actually coincide quite too closely to what we have today. In fact, it could be just an afterthought in terms of how transparent and secure blockchain actually enables us to become. But all of those things being said, I think there are a few players in the space that are doing it right. And groups such as Chang Group, I think, are very forward-thinking in establishing some of the right infrastructure to be able to execute upon that. Other groups such as Fidelity, very, very old brand, very traditionalist, but they also see that while demand may not be completely there yet, there will definitely be a need for the right infrastructure in place. And them stepping in as one of the big traditionalist brands and firms and saying, hey, we're going to do custody for digital assets is a really big deal. I think so. A lot of these things are actually very positive in indicating that we are moving towards the right direction.
Great. And Jason, anything to add from the VC perspective? What would make you allocate more?
I think for the VC perspective, we will look at blockchain companies. So cryptocurrency itself, we will stay away from that due to volatility. Even though in our space, we want volatility where we want a 3x, 10x return. I think blockchain companies will start to come out, so we definitely will look at it. We are early adopters for such technology, so we will look at that from a VC perspective. And what we're seeing right now is more and more corporates starting to come out, starting its own branch to look at investment into blockchain or crypto assets, or digital assets. So Don, if you guys want to set up a separate arm, we can help you run it. So that's what's happening. A lot of corporates are carving out a little bit of their AUM or their balance sheet to look at digital assets because they may not want to miss out, number one, or part of the technology could help in their company. So that could kind of help them push forward. Just now, DBS was talking about their company looking at different ways to get ahead of other competitors using technology. So from a VC standpoint, we definitely want to look at those. We will, one, startups, to have technology that can plug into big corporations. That's what we kind of push for.
Can I ask a quick question, though? Does that mean that
Sure.
you think that corporate treasuries and treasurers would be willing to make an allocation to a VC fund, as opposed to, because if this panel is about asset allocation, both the insurance guy and the former pension fund guy is saying we're still, as if it's just pure digital, we can't do it. We can't play in digital, directly in digital currencies. We can do other kinds of instruments that are a byproduct of what that company is doing, whether it's a blockchain and they're issuing a token, but if they also issue a stock certificate, for example, that we can play with, but not necessarily, or we can go through a venture capital firm that is making those kinds of investments. Is that what you're saying, potentially?
So potentially, banks are starting to carve out a sandbox, put some money in it, and look at blockchain. So, or look at startups in fintech. So we see that quite a bit from a corporate VC standpoint. That banks like in Thailand, there's a few banks that does that. So lots of corporate VCs are starting to come out, carve out a little bit of the allocation in terms of funds, and then look at companies, startup companies that can help their, plug in their technology to help their company. So yeah.
Okay, I'm afraid we're running out of time. Of course, a lot of very interesting topics being fleshed out, and please welcome to continue the discussions beyond this panel. Just 10 seconds each to wrap up, right? How long do you think it'll take? Same question I think from the last panel. How long do you think it'll take before digital assets will be more mainstreamed? Want to give it a shot? Yeah.
Mainstream, so that means
mainstream adoption means it would be accepted as a investable asset class in your space.
I think that's going to happen before the end of this year. I mean, Prometheum is one of the companies out there that's going to allow retail participants in the actual trading of digital currencies, or at least certainly security tokens. Institutions, if that's the second part of your question, or a part of your question, I think it'll still take 4 to 5 years. You know, there's the issue of alpha versus beta, and some folks are looking for alpha and some are looking for beta, and those looking for alpha are much more likely to do more riskier things and make allocations and experiment than those folks who are just looking for a certain kind of consistency for whatever their needs are.
Right.
So I think
4 to 5 years? Okay.
I think for the institutions, we're talking 5 or 6 years. For retail, it's going to be launched before
tomorrow.
The end of the year.
Right.
It's going to be before the end of the year.
The end of the year, that's right.
I think the technology developed very fast. I think for us, another thing is custodian side. It's big issues for institutional investors because there are all this story about technology hack and all this make institutional investors losing their privacy key. It's a bigger threat. Yeah, once the custodian side can be able to regulate it, meet the regulators' requirements, and will be slowly going to the institutions' asset allocation thinking in the future. As one of the so-called tokenized private equity, I'm not sure you guys are familiar, it's happening. So basically, because private equity, we especially private equity, real estate, we tend to invest before it's not liquid enough. So that's a so-called tokenized, this private equity shares, which is happening in the US, which is facilitated the risk capital, facilitate the trading, facilitate the transfer of the private equity share, which is get a lot of institutional investors' interest. Yeah, I think this will be happening quite soon.
Quite soon?
Yeah.
A few years?
Although I'm an insurance guy, but I'm quite optimistic on that.
Right. John?
Well, I think it depends on your definition of digital asset, because I think up until now, most people out there equate digital asset with the highly volatile upside potential of, say, Bitcoin or any of these alternative coins. But I think very shortly we'll come to see that digital assets is really just a way of managing different types of securities. And if you look at what Hong Kong Exchange is currently doing in pushing forward on that front with the potential of even securitizing these traditional asset classes, equities, fixed income, commodities, so on and so forth, into a digitally transferable vehicle, that could also be digital asset. And I think from that standpoint, we could see that coming to fruition just within the next 2 to 3 years.
Okay, great. We're out of time. Sorry, Jason, quick one.
Okay, very quick one. I agree with John in terms of how do you define digital assets. From a blockchain company standpoint, it's already here. This morning you heard from Dr. Xiaofeng, who talked about him investing in Bitcoin 4 years ago. To him, that's an asset class, it's not a cryptocurrency anymore. That could be an asset class that's already here. So it really depends on the definition. So from a company standpoint, I would say it's already here. But from a cryptocurrency standpoint, I think it will take some time.
Great. Thank you so much. May everyone join me in thanking the panel for their insights.